Today's episode is brought to you by Mazars. SoundCartel. It's always good practice to understand the tax consequences of your financial choices, and that includes, of course, how you structure your personal and business loans. From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. Tax expert Michael Jones, a partner at Mazars, says there are implications whether your loan has a redraw or offset facility. He explains what they mean and the difference between the two shortly. First, with interest rates at such historical lows, Chris Ashmore asks Michael if now's a good time to re-examine your current loan structure.
Chris, it absolutely is a good time to think about how your loan is structured. And the point is that different structures produce different tax results in all fields of commercial activity. And today we can look at the different tax outcomes that arise from using a redraw facility on your loan as compared to an offset facility. Both facilities aim to help you manage cash flow and minimise interest on your loans, but often they produce different tax outcomes.
So what is the difference between a redraw facility and an offset facility?
Well, if your loan has a redraw facility, then you can deposit money into the loan to reduce the loan balance and then later redraw that money when you need it. And that temporary reduction in the loan balance reduces the amount of interest you pay to the bank on your loan, which is always a good thing. Now, similarly, but different, an offset facility is a separate bank account that is linked to your loan account. And with a offset facility, deposits are made into the offset account and the combined total of the loan balance and the offset account balance is used to calculate interest charges. So both these facilities enable deposits to be made to reduce the overall loan balance and thereby reduce your interest expense. And both enable that the money deposited to be withdrawn later.
Okay, so what's the tax difference between the two?
A tax deduction is available for an interest expense when the interest expense is incurred in connection with earning income. Therefore, you have to ask yourself, what was the use of the borrowed money? Was it to, say, acquire a property to earn rent? In that case, an interest deduction can be claimed on the interest. But if the money's used for private purpose, where there's no tax deduction. So, for example, if you were using the money to buy a home or pay personal tax or travel overseas for a holiday, do you remember what that is, Chris? Anyway, if there is insufficient connection with income earning activities, then there is no tax deduction.
I see. So a tax deduction for interest requires the borrowed funds to be used in connection with earning income?
Absolutely, yes. So now let's apply that rule to offset accounts and redraw facilities. I'll use an example where, say, you've borrowed $1 million to acquire a property to earn income from rent. Separately, you've also sold a property and you know that you have a $500,000 tax bill that will be due in 12 months' time. So you decide to use the $500,000 to reduce your loan balance over that 12-month period until you then need the money to pay the tax. And this will reduce the interest you pay. So how do we do it? If you have a redraw facility, you pay $500,000 directly off the loan balance, and then you redraw the money in 12 months. When you redraw the money, you need to again ask the question, what is the money used for? And the answer is to pay a personal tax bill, which is a private use, and therefore insufficiently connected with income earning activities, and therefore there is no tax deduction for the interest expense on the $500,000. The purpose of your original $1 million loan has now changed to being 50% used for acquiring the rental property and 50% used for paying your personal tax bill. So as a consequence, a tax deduction can only be claimed for half the interest you pay the bank, because now only half of the loan is used in connection with earning income.
Okay, so that's the tax analysis for the redraw facility. What about the offset facility?
Well, using the same example of $1 million rental property loan, the $500,000 is paid into the offset account and the $1 million loan account remains untouched. With the offset facility, interest is calculated on the combined balance of the loan account and the offset account. So for 12 months, the interest expense is reduced thanks to that $500,000 deposit. Then, when the time comes, the $500,000 is withdrawn from the offset account to pay your personal tax. The purpose of the rental property loan has not changed at all, and a tax deduction remains available for 100% of the interest expense on the loan. The offset facility has a different tax outcome because the offset facility is a separate bank account and the use of the money from the loan account does not change.
Well, that's useful information. If someone wants to access these loan management mechanisms, what should they do?
Well, Chris, it's important to have your eyes open to the tax consequences of your financial choices. Banks don't all provide the same financial products. Some allow offset accounts for trusts and companies as well as individuals, and other banks, they only offer it to individuals. So you need to be aware of what they offer, what the fees are for banks for having these accounts, what comparative interest rates are, and specific rules for deposits and withdrawals. So really, as I often say, it's just well worthwhile having a meaningful conversation with your accountant first on these matters, so when you go to the bank, you can ask the right questions. So pay attention to the detail.
That was tax expert and partner at Mazars, Michael Jones. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.